Welcome, everyone. Today's webinar, this month's webinar, is on 5 tips to protect your assets and reduce your taxes. I'm Roman Basie. I'm an attorney, CPA, and managing real estate broker. We were asked to do this webinar for a particular lecture that I'm giving in January to an association. And so we made it this month's webinar. It seems to be of paramount importance these days, especially right now in these rather fruitful economic times. How are we going about protecting our assets and reducing our taxes? Those tend to go hand in hand. So let's take a look at the 5 ways that we really think about this when we do this. So if you're a small business owner, or you're in charge of a company, or you're thinking of running a company, or you're helping out with a company, these are the 5 ways that we look at protecting assets and reducing taxes. So we're going to talk about entity selection. We're going to talk about setting up trusts and the different types of trusts that there are. We're also going to talk about the importance of record keeping and the division of record keeping that can be required in a company. Personal goodwill, the use of personal goodwill to reduce taxes, especially when we help sell a company, and stock redemptions and how we use stock redemptions to also lessen the tax liability. And I want to caution all of you, as I do almost every month, these are 15-minute short little webinars. However, each one of these topics we could speak at length on, given an hour or 2-hour lecture. So this is just a way to introduce you to these items. And if you have questions, please contact me after today's lecture. So asset protection and tax liability, they somewhat go hand in hand. Typically, in order to achieve one, the other does have to be properly structured. So we're looking at the slide now that says entity selection. And so let's take a look. You may tell me, well, Roman, I run a company and I want to make sure that I'm protecting my assets best. Okay, so my question to you is going to be, what type of company are you? Are you a sole proprietorship? And what do I mean by that? That means you report your company's earnings and losses on your personal tax return, which would be your 1040. So if you tell me, well, Roman, I don't file a business tax return, then most likely you're a sole proprietorship and you're filing your taxes on Schedule C of your tax return, which flows through to your 1040. You may also be a general partnership. You may be filing a 1065 tax return, and that's also a flow-through entity. Any money your company makes or any loss your company has flows through to your personal tax return if you are a partnership. Let's skip a bullet point. Let's go to subchapter S. If you're filing your company as an 1120S corporation, that is a subchapter S corporation. That files its own tax return like a general partnership, but that also flows through. So the income or loss from the company flows through to your personal tax return. And then finally, we have C corporations. You're filing an 1120. You may be paying tax on the profit on a company tax return, and then any money you take out, you'll pay tax on that on your personal tax return. It's not always a bad thing. We hear a lot about double taxation with C corporations, but that's not always a bad thing. Did you know the first $50,000 of profits in a C corporation are taxed at 15%? Whereas if you're in the higher tax bracket as an individual, let's say you're a 25% tax bracket income payer, or 35%, or 39.6%. If you're running your company as a sub S and you're showing less than $50,000 in profits, you're paying more tax on the profits of your company as a sub S than you would as a C, believe it or not. So for tax reduction purposes, just because you're a sub S may not be the best suited company for you. You really need to have a tax analysis done of what are the taxes that you could be paying. And keep this in mind. We have a current proposal in the House Ways and Means Committee, and that's where our tax legislation is created from. And we have a proposal in the White House for their tax legislation. Both of those are proposing a flat tax to the S corporation. One's proposing 20%, one is proposing 25%. And also both proposals lower the C corporation tax rate. So in the future, it may not be the best to be a sub S corporation for you for tax purposes. If you tell me you are a limited liability company, I still want to know, are you a sole proprietorship, general partnership, a sub S, or a C corporation? A limited liability company does not exist for tax purposes. You still have to elect another method of taxation. So don't tell me you're an LLC when I ask you what type of entity are you being taxed as. You need to know if you're a business owner, if you're an accountant, if you're a controller of a company, if you're the bookkeeper for a company, if you're the tax preparer. You need to know what form of company is the limited liability company being taxed as. And I'm going to throw something out for you, and we'll talk about this. And here it is on this slide. For asset protection purposes, one of the newest methods in the United States is something called a series limited liability company. If you're listening to this webinar and you've not heard of that terminology, you need to Google that terminology, learn about a series limited liability company, and learn how it can protect the assets of the company. Not all states have created these legal structures yet, but some have, a lot have. More than 20 states now have a series limited liability company, and the number continues to grow. When I first started talking about this series limited liability company 4 or 5 years ago, there were only 8 states that had them. Now there are more than 20. What if your business is in a state that doesn't have a series limited liability company? For example, Florida. It's possible that they will allow one that is registered in another state to be filed as a foreign entity in the state which you are located. And let's use Florida as an example. Florida rewrote their LLC statute a year or 2 ago, and they said, look, we don't have series limited liability companies. But if you are one in a foreign state like Illinois, if you are a series limited liability company in Illinois and you file that in Florida as a foreign company, we will allow you the benefits and protections of the series limited liability company. Florida put that in their LLC statute. So just because you're in a state that doesn't have one, don't think that you can't file it somewhere else. Okay, what is it? It's a limited liability company that has elected to create multiple divisions called series that operate within the company. Each division is allowed to own its own assets and to have its own liabilities. And look at this. The liabilities of one division do not cross over to another division. So the benefit is you've divided up any liabilities between 2 or more categories of assets. You've protected those assets from each other, yet you have the simplicity of still only dealing with one company. It is wonderful. As I said in my opening, I'm a real estate broker. I have a real estate investment company. We have a series LLC. We formed about 6 or 7 series underneath it, and we put different assets from that company, different properties into different series. Therefore, if one property has a liability that is created, it will not flow over to the other series, protecting those assets from each other. Okay, while we're on the topic of asset protection and really tax minimization, when you talk about estate tax planning, you know, I help buy and sell and do succession planning for privately held companies all over the United States. And of course, we try to do asset protection. But one feature of all of that is estate planning once our transactions or our succession plans are done. So one way we do this is by setting up trust. It's a great method of asset protection. It's good for estate planning, but I want you to know something. I don't care what you call the trust. There are only a few types of trusts in the United States, and really it boils down to 2. Either it's revocable or it is irrevocable, meaning if it's revocable, you can change the trust. If it's irrevocable, you really can't change the trust without court action. Now, there are other types of trusts: charitable remainder trusts, special needs trusts, supplemental needs trusts. But again, this goes to the heart of, are they revocable? Are they irrevocable? what you need to know from a tax planning perspective, from estate planning. If it's irrevocable, it is not considered in your estate after 5 years. You set up a trust. You put your business into the trust. After 5 years, the value of your business is not considered to be in your estate. And right now, you can pass away with $5.49 million in your name of value in your name and not pay tax. If your business is worth more than that, your business, your assets, your life insurance, everything you own, if it's worth more than that, you should highly consider some estate planning that deals with trusts. Revocable doesn't help from an estate, from a tax standpoint. It's still considered in your estate. Both of them help for asset protection. If assets are in a trust, they are not technically owned by you. Therefore, it helps for asset protection. Okay, let's move on to record keeping and formalities. Corporations are set up to insulate owners from liability. So even in the case of a sole shareholder, you may say, Roman, I own my company, but I am the only shareholder. The corporation can still protect the owner from liability. And we even have some states that relax the formalities. Illinois, for example, has something they call a close corporation. If you are a close corporation in the state of Illinois, the formalities are relaxed, meaning if you don't do minutes and bylaws and record keeping, the judges, the courts may come in and say, okay, the statute allows for the relaxation of those rules. You still have corporate protection. If you are not a close corporation, and many states do not allow anything called a close corporation, then you should follow record keeping. You should have a corporate record book. You should have annual minutes. You should have special minutes when the company does major events. Look, a business entity is of no use unless it follows formalities and keeps records. It's one way for us attorneys to pierce a corporate veil in a lawsuit and go after your personal assets. And what do you own personally? Your home, your vehicles, the stock of your business, your investments. And in a lawsuit situation, when an attorney can pierce the corporation and get to the shareholders, then they have something collectible. So keep that in mind. There's two big cases. I'm not going to go into them today, but those two cases demonstrate the point and the importance of record keeping and formalities. Let's just briefly touch on personal goodwill. In the sale of a business, if you ever think about selling your business or merging or acquiring a company, there's always tax implications on both sides. The buyer and the seller have tax implications. When we can use personal goodwill, this helps reduce taxes. If we can sell personal goodwill in a transaction, it's taxed as capital gain instead of ordinary income. That can be as much as a 15% savings on every dollar. It stems from a case called the Martin Ice Cream case. It requires two contracts, one to sell the business or the assets or the stock, and one to sell the goodwill of the individual. If you happen to be a C corporation, it's highly beneficial and can save a tremendous amount of taxes. And finally, and again, everyone, these are just a very few couple of topics that we talk about when we talk about saving taxes and asset protection. And we look at stock redemptions. If I'm doing a succession plan and I'm transferring the business to maybe a key employee of yours, maybe a family member, maybe a local competitor that knows you well, I like to use stock redemptions. This is company money used to purchase back your stock in the company. We convert what would have been an ordinary gain to a capital gain. We use a buy-sell agreement if we have to, and we can increase the value of assets through proper allocation. But the bottom line is, if it's a succession plan, if it's a transfer to a key employee or to a family member, this is typically what's going to be used to minimize taxes in a transaction. You know, in conclusion, There's changes in the tax code on the horizon. It's increasingly important to understand the business taxation you are currently experiencing. Is your choice of entity selection the best way for you to go forward? If you call our office and say, Roman, I want you to take a look at this information, we'll look at your tax returns, your financial statements at no charge. We'll have a phone call with you at no charge. We'll tell you what we're seeing. We'll follow that up with a list of recommendations if we think you need to change something. We'll follow it up with a list of recommendations and our cost to helping you do so. So please, if you have any questions, feel free to contact me. My email is rbasi@taxplanning.com. There's not a slide on here right now. We will add a slide with all of our contact information. My phone number is 618-997-3436. Like us on Facebook, share our posts. We try to post on there often. I look forward to hearing from you, and thank you for listening today.